Okay, today's lesson is a continuation in this discussion in this unit on the financial planning pyramid. This relates to the asset protection and wealth accumulation that we've been talking about. If you remember, the foundation for this pyramid is going to be the combination of the money management and insurance. It's all the stuff that's been discussed over the last 3 months. It's your budget. It's your saving for emergencies, all aspects of not abusing the credit, the shopping smartly and using the comparison shopping, protecting all of your assets with the various types of insurance. That's the whole asset protection piece. The actual wealth accumulation occurs when you start investing in a variety of investments that are of varying degrees of risk. The pyramid represents the level of risk for each of these investments, where the base of the pyramid are your lower risk investments and the top of the pyramid are your highest risk investments. The low risk investments, the reason it's at the base, because that's where the largest percentage of your investment portfolio should be. And as you go up in risk, the smaller percentage of your overall investments should be in those higher risk investments. What we're going to talk about today are those individual type investments that you could have, the risk that's associated with them, and how that's going to relate to the return that you see on those investments. In other words, how much it's going to grow. Here's the subjects we're going to be covering today. So let's go ahead and get started. First thing we need to talk about is actually what is risk. Well, risk is real simply the chance that you're not going to get the money from your investment back. There's always the chance that your investment will not make you money. If you have stocks, they may actually lose value. And what winds up happening is when you need to sell it, you're not able to sell it for what you bought it for. Not only that, but maybe you have a bond, and a bond issuer may default on its bond. In other words, they're not going to pay back the money that you loaned them through that bond, so you lose the money that you invested on the bond. Another type of risk that you have with investments is the chance that your investment doesn't do as well as other investments you could have taken advantage of. That is known as an opportunity risk, and you may just have an investment that you lock into, and it doesn't grow in value as quickly as maybe another option you would have had at the time. So those are the two basic kind of risks. The most common one that you're going to deal with are the ones where your money just doesn't make the money back. The other one, it takes a lot more number crunching to determine if you even had that happen to you. But most folks just worry about, am I making money or not? Am I making the kind of return that I want to on the investments that I'm making? First thing you need to do before you can decide what you want to invest in is figure out just what's your tolerance for risk. And what I mean there is, are you willing to put up with the fluctuations in the value of your investment? Investing is a lot like riding a roller coaster. Okay, some roller coasters are not that aggressive. They go up and down a little bit, move around, not very scary. Other roller coasters go up and down a lot. They climb real high and they drop real low and they do a whole bunch of stuff in between. Some investments work that same way. You just have to figure out how much are you willing to put up with the ups and downs. Can you actually handle those ups and downs that are going to occur in the market? Because they will. If you had something and it lost a fifth of its value, would you be freaking out? Would you be wanting to sell? Would you be losing sleep at night? That's an indicator of your risk tolerance. Another thing that's going to drive that is really, what are your investment goals? When do you need the money by? And how much do you need to grow by? It's going to drive how much risk that you're going to want to be taking on. You also want to invest or decide, are you more concerned with losing money, or are you more concerned with making as much money as you can? And that's going to help determine what kind of risk you're willing to take. And also, like I said, when you need the money and how much do you need? Because the longer time frame you have, if you remember the lesson on time value of money, the less risk you're going to have to take because you don't need as big of a return on investment. But if it's a shorter time frame, you need to be more aggressive if there's a whole lot of money that you feel you need to make. On the flip side, though, if you don't have very much time between when you need the money and now, you may not want to take a lot of risk because you won't have time to recover from a potential loss. One very, very safe investment are some insured deposits. What I mean here is there are certain things you can do and money that you can put with financial institutions that has insurance. In other words, you don't have to worry about losing that money. It's guaranteed that it's going to be there. For example, the Federal Deposit Insurance Corporation insures deposits in banks for up to $250,000. That means that should something happen with that bank, you're not going to lose the money that you have on savings in there or even in your checking account, because that deposit is guaranteed for up to $250,000. For credit unions, the National Credit Union Association does the same thing, $250,000. Now, most folks don't have $250,000 of cash laying around, so really for most of the population, this is plenty of insurance on the money that they put with their financial institution. That specific fund that takes care of that insurance for the NCUA is the National Credit Union Share Insurance Fund. Where does this insurance come from? How does it get paid for? Well, financial institutions actually have to pay for it. They do that because it's their responsibility to protect you against the loss of your money. You don't have to insure it yourself. It's a federal requirement that they provide that. So your deposits will be guaranteed up to that $250,000, whether you're with a bank or a credit union. Thing you got to keep in mind, though, some of the other types of investments we're going to talk about today, stocks, bonds, and even when we get into mutual funds in our next lesson, you cannot get insurance on those. There is inherent risk involved. You can't insure in this manner against the potential that that money suffers a loss. One thing you can do with the financial institution is get a money market account. Now, this is really just a glorified savings account with a bank or another financial institution that has a high minimum balance. The deal here is because there's a high amount of money that you need to keep in there as far as minimum balance, they're going to pay you a higher interest rate than your regular savings accounts. What happens is that financial institution, for example, a bank, they can take that money, they're going to loan it out. They're going to be charging, obviously, a higher interest rate than they're paying you, but because they know they can guarantee to have at least a minimum amount on which they're going to have to pay you, then they can at least loan that amount out, and probably more, and know they're not going to have to give it back to you in a moment's notice. Because if you do want it back or your balance drops below the minimum, they're basically going to cut off paying you any interest. And that's kind of the way these work. So if you do have a large amount of money, and this might be like a $10,000, $20,000, might sound like a lot right now as a teenager, but when you're in your 30s or 40s, you may have larger amounts of money that's available to do that, but you might want to have ready access to it. Businesses take a lot of advantage of this, and they still need the advantage of being able to get it at a moment's notice. But when they don't need it, they can get it earning them money, again, while they sleep. Certificates of deposit are another insured deposit that you can take advantage of at a financial institution. And basically what you're doing is giving them this money and saying you can hang on to it for a specified amount of time. It might be 6 months, a year, 2 years, 5 years. During that time, though, you're not allowed to touch the money. They're guaranteed to be able to take that money and do things with it. In other words, loan, and know they're not going to be responsible for getting it back to you for whatever time you committed to. But the advantage there is they're going to pay you a higher rate of interest compared to a regular savings account and even to a money market account. Because they know they don't have to provide it back to you, they don't need to make sure they have that on hand. They can go ahead and loan it all out, make the money that they can off of that, and then, of course, pay you your guaranteed rate of return. No chance of loss here either. It's federally insured. Another kind of investment that's out there is called a bond. Now, a bond is a type of loan. And what you're doing as an investor is whoever's issuing that bond, you're essentially loaning them money. Who invests or who issues these bonds? Well, the federal government does. That's basically how they fund a lot of their spending. The money that they're borrowing is done through a government-issued bond. Cities and counties also will build schools, build roads, things along those lines with bond money that they want to having to pay back. And then corporations, when they want to expand or when they need to raise money, in other words, capital, they'll also issue bonds too. Now, how does this work? Well, what happens is you give them the money now. They say at some future date, which is called the maturity date, they'll give you that entire amount back. Now, between now and then, they're going to pay you interest on that bond. They're going to guarantee you that interest rate, and you'll get that money whenever the bond says, annually, whatever it might be. One thing about bonds also is that there's actually a thing called a bond market, where if you don't want to hang on to that bond until maturity, you'll be able to go sell it if you want to. And that's advantageous if you think you want to move your money into something that's doing better. You don't need to hang on to it. If you bought a 20-year bond, you don't want to hang on to it for 20 years. you could probably get somebody else to buy it. Now, some of the bonds that are out there, well, one's called a U.S. savings bond. What's a savings bond? It's issued by the government, the U.S. government specifically. And what they do is, if you get a $50 bond, savings bond, you pay $25 for it. You're paying half the face value. And the values can range from anywhere from as low as $10 to $10,000. What happens is that the value of the bond gradually grows to its full value over the life of the bond. This is referred to as a zero coupon bond. Instead of having to loan the full amount and collect interest on it, basically you're giving half the face value, and then over time, that bond's value at that point in time grows until it eventually reaches the full face value of the bond. And you can take that sucker and cash it in at any time if you want. It's just going to be whatever the current value is based on when it was purchased and when its maturity date was. They have a guaranteed amount at any point in time. It is also risk-free. You don't have to worry about losing money. The U.S. government guarantees that you'll get your money. The only risk that you run is that sometimes these bonds can earn less than actual inflation, so your money's actually losing purchasing power. Even though it's growing, it's not growing as fast as prices. Another type of government bond that's out there is called a U.S. Treasury bill or a Treasury note or a Treasury bond. There's 3 different kinds. It's just based on how long that bond is until maturity. You see here, Treasury bills less than a year, Treasury bonds more than 10 years, notes there in between. The deal about these is they actually pay you the guaranteed interest every 6 months. You get money every 6 months from them on those. It's not the zero coupon where you pay less and it grows. Here, you loan them the full amount, and you get an interest payment every 6 months on that full amount. What's also nice is it's also risk-free. It's guaranteed by the U.S. government. However, you do need to worry about it not growing as fast as inflation. Corporate bonds are another kind that we can talk about. Now, these are ones that companies issue. So maybe it's a company like Apple or Amazon that's wanting to build this new headquarters that you might see in the news. They may want to raise money to do that, and they'll issue bonds. Now, corporate bonds in general are riskier than government bonds because one of the risks you run into is that company may wind up at some point having problems paying their debt. Not necessarily, but they might. Municipal bonds kind of fall in between. These are the ones done by the state and local governments. And again, it's for like schools, county office buildings, fixing roads, things along those lines. The nice thing about the municipal bonds compared to the corporate bond especially is that your earnings are tax-free. They don't pay as great of an interest rate as a corporate bond, but in a lot of cases, what they're hoping is that when you combine looking at the risk of that bond, which is less than a corporate, but more than a federal government bond, that once you factor out the fact that whatever you make on the corporate bond, you have to pay taxes on, whatever that actually nets out to be, may turn out to be less than what you could earn on a municipal bond that may actually pay less, but because you never have to pay taxes on the money you make on it, you would actually come out ahead. And in fact, I read a few years back an article that talked about people that earned $1 million or more in a year but never had to pay taxes. The one common thread that they had amongst all those investors is they tended to make all their money from tax-free municipal bonds. So rather than earning money, say, investing in a business and then having to pay taxes on it, they basically lent money to the government, and the government had to pay them for using their money. They are less risky than corporate bonds, but generally a little bit more risky than a government bond because a government bond is guaranteed. A municipal bond is not. Now, you can figure out how risky a bond is by what its credit rating is. All these corporate municipal bonds, there's 3 major rating agencies, Moody's, Standard & Poor's, and Fitch, that do ratings on them. And what they do is they look at how credit worthy that bond issuer is. So just like you have a credit score, this bond rating serves as a similar kind of thing. Now, they have some that are investment grade, which are very low risk, and then they have some that are non-investment grade, which are considered high risk, high yield, and then a lot of times referred to as junk bonds. If we take a look at the, excuse me, wrong screen. Let's go here. Oops, trying to find the screen here. There we are. Right here, these are the municipal bonds ratings. You see, you have anywhere from AAA on down. Moody's, Standard & Poor's Global, and Fitch have their own similar ones. The highest qualities have what it's called a AAA rating. Then they have the high quality, medium, and then lower medium grade, and it just kind of goes on down from there. They have down into the C's also. which are more your junk bonds that are the higher risk ones. There we go. Another kind of investment are stocks. You might already be familiar with stocks. Remember, this is where they're known as equities, and you actually own part of a corporation. You own a little piece of that whole corporation. What corporations do is they sell little portions of themselves to raise money. And what happens then is that whoever those shareholders are, they basically legally own a portion of that company, and they have a say-so in the governance of that company. Generally, people will buy stocks because what they hope is that when they want to sell the stock, it's actually worth more than when they bought it. That's really how most investors invest in the stock market. There are other ways, but that's really the primary way we're going to focus on right now. The real risk that you run is that when it's time to sell, that the price of the stock is less than the purchase price, and you don't make any money, and you maybe wind up losing money. Some stocks that are out there pay what are called dividends. Now, a dividend is when, say, every 3 months, that corporation says, hey, how much money do we make? They decide, okay, let's keep a certain amount. It's called retained earnings. And then decide to pay a dividend to all their shareholders, basically taking some amount of their profits and saying, we're going to divvy it up amongst all our shareholders. And they say, what we're going to do is give you X amount for every share of stock that you own. So it might be 10 cents a share, 25 cents a share, 51 cents a share. They're going to determine that every time they decide to declare a dividend. So, for example, if they say it's going to be $1 a share for a dividend and you own 100 shares, you're going to get a check for $100. This is another way that some folks try to make money by owning stocks, because there are some stocks that generally tend to pay a lot of dividends, and an investor may choose to invest in that stock because not only are they hoping that the price will go up, but then in the meantime, they're going to continue to receive dividend checks from that company for the shares that they do own. Sometimes a stock will split. Don't want to get into this too much in detail, but just what happens is sometimes the price gets so high that the company decides we need to do something to try to lower its share price so that it trades more. So what they'll do is say, on this date, we're going to do a 2-for-1 split, 3-for-1, whatever it might be. And what happens is, for every share of stock that you had, and if they do a 2-for-1 split, you now have 2. Now, obviously the value of each of those shares is going to go down, but because you have twice as many, you still have the same value of investment, but now the stocks probably have more of an opportunity to grow in price because more people are willing to trade on stocks that have a lower price. So, for example, let's say you had a stock that was worth $100 and it made $1 per share in growth in the price. So it goes up to 101. Okay, you made $1. But what if you had that stock and it did a 4-for-1 split? So now you have 4 shares at $25 a piece. The stock goes up by $1. You just made $4 on your $100 investment instead of just 1. So you can see how a stock split can benefit investors, because now there's more ability for that price to move, and for any movement in price, you're basically going to make 2 times as much, 3 times as much, 4 times as much as if the stock at a higher price would have moved that same amount. So here's another good example. If it's owned for 200 share, again, you're going to make 4 times as much should that stock go up by $1 than if that stock went up by $1 when it was still selling for $200 a share. One way that you can buy stocks is this thing called a dividend reinvestment program, also referred to as a DRIP. This is where companies that pay dividends on their stock, sometimes they offer this opportunity. Rather than them sending you a check, they say, I will just give you a little bit more in stock. So now the value of the stocks in that investment will go up, and instead of receiving a check and then the stock prices, the value of that stock kind of staying the same or going up or down a little bit, you can now grow the number of shares instead of taking the cash, and you might actually see a more rapid growth of your investment if the share prices continue to go up than if you kept bleeding out that return that you're making on the investment, the money that you're earning. Where do you get stocks? Well, you got to go to a stock market. In other words, something called a stock exchange. And you can't do it yourself. We'll talk about that here right now, because you need to go through what's called a broker. The stock market is basically where stocks are bought and sold by traders. The brokers that do the trading there, they have paid for a membership on that exchange to buy and sell. You can't just go in and say, I want to buy 100 shares of Apple. You have to go through a broker. Thing you got to keep in mind also is that not all stocks on the open market are listed on any of the given exchanges. Each stock exchange has specific listing requirements that a company must meet before they're listed on the exchange. It might be the size of it. It might be something along the lines of the kind of money that it makes. It just varies by exchange on what they're saying. Hey, if you want to be able to have your stock traded on this exchange, here's what needs to be going on with your company. What are some of the stock exchanges? Well, the most familiar one you might be familiar with is New York Stock Exchange. Anybody want to guess where it is? Yeah, that's right. It's up in New York. It's actually on Wall Street. That's where Wall Street became the financial center. It was created back in the late 1700s. What happened was 24 brokers just kind of hanging out. They said, hey, let's just trade with each other. If anybody wants to buy any stocks from you, they got to go through me, and vice versa. If anybody wants to buy from me, they got to go through one of you. And companies can only sell their stocks through us if they want to trade them at this exchange. Now, obviously, there's a lot more brokers now. In order to become a broker, you have to pay for a seat on the exchange. And not only are you paying for it, but then there's other requirements. There's going to be certification requirements for the folks that you have doing the trading. And there's just a lot of stuff, more than we really need to know for this class. But just know that those brokers pay for that seat. They're the only ones allowed to trade. They're supposed to prove that they're smart on trading stocks so that customers that go through them should be able to trust them. On the New York Stock Exchange, not all the stocks that are out there are available on the stock exchange because they do have some pretty strict listing requirements. There's also something called the NASDAQ. Now, the NASDAQ was actually a fully automated exchange. It's the first fully automated stock exchange, where at the New York Stock Exchange, where they used to get together in trading pits and physically engage each other in buying and selling transactions. It means they're talking between each other and saying, hey, I got $100 or 100 shares to sell of Harley Davidson or something. Somebody says, oh, yeah, I've got somebody who wants to buy 100 shares. And they kind of negotiate a deal. This is all done online, and it's all fully automated. It's been around since the early 70s, and they don't have a strict listing requirement, so there's a lot more stocks that you're going to find on NASDAQ than you'd be able to find on the New York Stock Exchange. And there are actually exchanges all over the world. There's ones in London, Hong Kong. Pretty much every major country has its own exchange. Stocks actually can be listed, though, on multiple exchanges. There's several exchanges just in the United States alone. And what happens is these exchanges actually talk to each other, sharing what the latest trading prices are on each of the stocks, so that it doesn't matter where you go, which exchange you go, as long as that stock is selling, you're aware of the latest trading price, regardless of what exchange it actually traded on. Now, how are stocks bought and sold? Well, it really works a lot like an auction. What happens is you have buyers that, through their brokers, come and make a bid on the stock. Say, I'd like to buy 500 shares of General Motors. Or I'd like to buy General Motors, and here's what I'm offering as a price. So they make an offer. And that's actually referred to as the bid price. So when you're looking at some quotes, you actually see bid prices, and then what you'll see is what the sellers are listing as their desired selling price. And that's called the ask price. So you got buyers bidding, sellers asking. Well, if buyers are willing to pay the ask price of all them are, then they start trying to outbid each other. So let's say you have 5 people trying to buy shares of, let's say, Facebook. Okay. And there's one person selling Facebook. Well, the person that's representing the person selling the Facebook stock is going to say, hey, somebody make me the best offer. And what happens is the buyers start trying to outbid each other. And that's when the price on that stock starts to go up. It's purely supply and demand. If there's more demand for that stock than supply, it's going to push the price up. And what will happen, though, is price will go up. What happens is some of the buyers back out of the market. Other sellers will say, hey, at that higher price, I'm willing to sell. And eventually they'll come up to some agreement on, and buyers and sellers will come to agreement. Now, on the opposite side, if somebody's trying to sell a stock and there's no buyers willing to pay that, the sellers are going to start lowering that ask price to try to entice buyers to buy the stock. And that's going to drive the price down. So when they're trying to sell it, the price starts dropping. When the price goes lower, some folks that are interested in buying but didn't want to pay that high of a price say, oh, hey, I feel like paying that now. And they start coming to the market. At the same time, Some sellers say, hey, I can't afford to sell for that low because I'm going to lose money, and they back out, and eventually buyers and sellers finally agree on a price, and then the trade takes place. And if you ever watch any of the financial channels during the weekday when the trading floors are open, that's what you'll see, that little scrolling stock prices, that ticker. It'll basically be saying, here's the current price, here's how many shares were traded, and is it up or down. Okay, and whatever that latest trade price is considered the current price. But there's tons of stocks out there, and how to evaluate what's going on with the market overall is very hard. And that's where a stock market index comes in. Now, all a stock market index is where some company, usually some financial services firm, has said, hey, we've come with this index, and we say these stocks that we're looking at, we feel best represent the specific market sectors. Like maybe it's industrial, maybe it's telecommunications, or mining, or retail sales, or anything along those lines. And they say, we think these paint a good picture, and what's going on with these stocks is actually what's going on with that sector. So what they do is they do things with the stock prices, combination and weighting, to come up with an index. Basically, it's just a number that's going to come out of a formula. So they will take the stock price and put it in their little formula they come up with for their index, and they do that with all the stocks that they're looking at, and then out comes a number from it. And the number really doesn't mean a whole lot in and of itself. What they're looking at is the changes in what happens with that number. And they're saying the changes in that index number, whatever number comes out of that formula, are believed to represent what the entire market is doing. Now, some of the more common indexes that you might see on the news if you're ever watching them, well, one is the Dow Jones Industrial Average. The Dow Jones Industrial Average looks at 30 stocks. And they say these 30 stocks that we're looking at each represent their sector of the market. The question you got to ask yourself is, can 30 stocks out of over 5,000 stocks that are out there actually adequately represent what's taking place in the market? Maybe, maybe not. If you take a look at the stocks that they actually have, they're pretty heavy hitters. Let's get this page pulled up here. See this number right here, this 2537. It doesn't mean anything as far as dollars. What they're looking at is how much has it changed since the day before. And in this case, you see this number has gone down by 600 points. It's not $600, it's just 600 index points. And in other words, it's lost 2.3% of its value in the last day. But if you take a look at these stocks, you see Johnson & Johnson. They do a whole bunch of what they do, baby powder, baby shampoo. They do a lot of stuff in healthcare. Okay, you've got Merck and Company, Procter & Gamble. You might be familiar with them from Pringles, Coke, Verizon Communications. That's cell phone networks. You got Walgreens. You got McDonald's, Walt Disney. I mean, you see here, they're not small companies. And they say, for example, that Visa Incorporated represents what's going on in the entire commercial credit, or the consumer credit industry, and Boeing for aviation industry, and Apple for technology industry. So they are pretty heavy hitters. It's just a matter of, you got to ask yourself, do 30 stocks really adequately represent what's going on? There's another index out there called the Standard & Poor's 500. In other words, called the S&P 500. And if you want to take a guess at how many stocks this one looks at, yeah, that's right, looks at 500 stocks. And they say that because we're looking at a lot more, this more adequately represents what's going on with the market as a whole. Because think about it. For example, with just the Dow Jones, McDonald's is on there. If you remember a few years back, McDonald's lost a lot of money in a lawsuit for some lady that scalded her crotch with hot coffee. And that drove their stock price down. Well, as a result, it drove the Dow Jones Industrial Average. Just because that lady won a lawsuit and McDonald's lost some value of their stock, does that really mean that the fast food industry as a whole was not doing that well? No, it was one stock that was just doing poorly because of something unique to that. But by spreading it out, looking at 500 more, and they're big companies, little companies, everything in between, they're all weighted based on how big the company is. And Standard & Poor's says, well, this actually more adequately represents what's going on with the market as a whole, because you don't have as big of an impact by one small company. If we take a look at those, oops, let me close this out here. You see, there's a lot more here. I mean, there's 2 pages, each was 250. You've got pharmaceutical stuff. You've got technology stuff, auto parts. This one is a health insurance company. You got a airline here, Alaska Air. I mean, these are just in the A's. We're not getting very far. You see, there's all sorts of different companies that are represented on the S&P 500. So if, for example, Apple doesn't do so well because maybe the sales of their iPhone didn't go as well as they did, it's not really going to have a huge impact on this overall S&P 500 index. If every single technology company had problems, then yes, that might actually be reflected in a bigger movement. Okay, so again, changes in prices of larger companies will have a greater impact, but it won't have as big of an impact as one out of 30. This is going to be one stock out of 500 that's making a change. Some things you might want to consider when you're investing is, do you want to just invest in U.S. stuff or perhaps do some global stuff? Because investing in a global company can be risky. The U.S. is very strict in reporting requirements that businesses have on their stocks, on their companies, on the financial health of their companies. And in a lot of other countries, it's not as strict. So some company could be lying about how their financial health is, and because there's no real oversight on that, you might think you're investing in a good company, and it turns out that they actually are doing really poorly. It's just they're lying about their numbers. But if you can find a good company, sometimes you can actually protect yourself against a downturn in the U.S. economy or even the U.S. dollar by investing in overseas companies. But there is some risk involved in that too. So how do you figure out how much money you're making? You do that through figuring out what's called the return on investment. And a lot of times you just hear this referred to as return. Like, what kind of return did you get on that? And it's normally expressed as a percentage. And basically it's the, if you want to call it, profit that you see on that investment. And it's a percentage of whatever the original investment was that you receive back on that as an investment. Now, how do you get return on investment? Well, there's 3 main ways. First off, and kind of the way that we looked at when you were doing your calculations on the last assignment, is through interest. And this is basically where you have lent somebody money and they are the borrower and they're paying you back that interest. So it could be your bank paying you interest. It could be the bond payer paying you, or bond issuer paying you the interest on that bond. So that's interest. Another way you can earn return is through the dividends that you receive on stocks. And you remember, those are the ones where they're paying you out part of your profits. That's a way that you receive a return on the investment because it's money coming back in addition to whatever you're going to ultimately sell it for. The third type is capital gains. Now, capital gains is the one where it's the buy low, sell high. So you have bought in something and you sell it for a lot more. The amount that you make between the purchase price and the selling price, that is a capital gain. And you can calculate what that percentage increase is. And in fact, that's what you're going to be doing on the assignment today, is calculating the actual return on investment based on a combination of potentially dividends or capital gains. And so the capital gain really simply is whatever you sell it for minus whatever you bought it for. How does this relate to return? Well, more risky investments generally have the potential to give a higher return. But then they also have the potential for a loss. The likelihood of loss is also much higher. So if you want to take more risk, you should expect a higher rate of return on that investment. If you don't have a very high risk tolerance, if your risk tolerance is very low, you cannot expect to earn a higher rate of return as you would with riskier investments. You can't say, oh, I don't want to take any risk, but I want to make like 20% return on investment. To make 20%, you're really going to have to take some risk. But you got to remember, the longer you're taking the risk, the higher rate of return you should expect, because the longer amount of time it's going to grow over. So because you are risking your investment dollar over a long period of time, you should expect a higher rate of return. Now, again, there's no guaranteed rates of return on anything we talked about today other than the bonds and some of those insured deposits, the certificates of deposit, money markets. This relates specifically to stocks. Okay, so if you are taking a lot of risk with a stock, you should expect a higher rate of return. And there's no guarantee you're going to get that, but that should be something when you keep evaluating your stock as you hang on to it. Where do you go to get stocks or bonds? Well, with the stocks, again, you've got to go through a brokerage house. They'll go and represent you at one of the stock exchanges and procure that stock. They'll get it for you on your behalf. If you use one of those dividend reinvestment program accounts, you can actually buy some stock directly from the company as they issue new stocks. The brokerage house, the stock market, is referred to as a secondary market, which means you're buying from existing owners of the stock. If you're again buying it straight from the company that's issuing new shares, that is where you can go directly to the company, and you don't need to go through a brokerage house on that. Okay, there's these mutual funds that are built out of stocks. We're going to look at those a lot more in the next lesson. You can actually buy stocks that are put into these funds, and you can buy those from investment groups. We're not going to dwell on that too much, but because we'll be addressing that a whole lot more in the next lesson. But that is a way you can actually buy stocks themselves indirectly through those mutual funds. With bonds, you can buy them directly from the bank. You can go straight to the government and buy them. There's also the bond brokers if you want to buy from other existing owners of those bonds that are looking to sell them. And just like with stocks, there's these things called mutual funds, which will pool together a bunch of these different bonds. Investment groups will do that. You can buy into those funds in order to be able to take advantage of the benefits of buying bonds. And that concludes today's lesson. And now it'll be time to do the assignment.